I'm Teneale.
And I'm Kelsey, and we're financial advisors from 𝐴𝑙𝑚𝑎𝑛 Partners TrueWealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast.
Welcome to Wealth Experience, a podcast that brings thought-provoking conversations to life surrounding all things wealth and prosperity. Today, I'm thrilled to announce our guest speaker, Corey Evans, Life Risk Advisor from Personal Risk Professionals. I'm going to call that PRP for short, Corey.
Yeah, that's it.
So a bit about Corey. He spent over the last decade providing families and business professional advice for their life insurance needs. He's based in Brisbane, Queensland, and is a member of the Financial Advice Association of Australia. We call that the 𝗣𝗺𝗃𝗃, lots of acronyms in financial planning, and has completed studies through Griffith University. So welcome, Corey.
Yeah, thank you. Good to be here.
Yes. Welcome for coming up to Mackay. It's always good to see you in town.
Yeah, it's good to be here.
Yeah.
It's beautiful weather this time of year too.
Absolutely. And today we're going to be talking a little bit about life insurance.
Yes.
So why every Australian needs to be paying attention to this area of their financial house and what you need to be keeping an eye out for on your existing policies and perhaps obtaining cover if you haven't already considered it. So do you want to tell us, let's start out knowing a little bit about Corey. What does a typical week look like for you? What's your life like?
Yeah, so I guess professionally, a standard week is lots of emails, lots of phone calls, dealing with new clients, existing clients, policy queries, claims, everything on that front. So it's a quite a heavy space, which requires a lot of expertise, which people find out once they go through the process. So it's generally fielding a lot of questions about things and the like, lots of meetings, meeting with insurers, that type of stuff. So generally pretty packed.
And what I love about your role is that there's so much involved in it, and insurance can be such a heavy area to think about, but you definitely take a lot of that stress out of it for individuals, for claimants, for clients, by taking all of that work on yourself and allowing them to, go through that process and have the thought about, well, what do I need to think about for the family?
Yeah. And I always kind of position it as if a lot of people are used to potentially using a mortgage broker. It's the same kind of process for us. You deal with a mortgage broker to take away that stress of dealing with the bank. You let them do that, fight that battle for you and tell you what needs to happen and why, and educate you through that process. And it's the same thing for our end. And a lot of people think that it's a very easy space. I think because they're attuned to thinking that they can, go online and just get quotes, and like they do for car insurance, through the compare the market and stuff like that. But it's once you get under the hood of life insurance, there's a lot of T's and C's that go on, which most people are ill-informed about, and that's where a lot of frustration comes with the insurers, because they're not understanding what they're covered for and how it works.
That's right. And I guess what's interesting when you say that is it kind of makes me think, well, when you first go and buy any product, usually like if I went out and bought a car, I'm going to know straight away whether that car is exactly what I want it to be. But with insurances, you don't know until it comes time to make a claim, right?
Yeah, for sure. And that's where a lot of people get mixed up in that space, because there's a lot of different definitions for different products, how you structure them. You're being held in your personal name or in super has different tax consequences, both for the life of the policy, how you claim on it, in terms of tax deductions, and then also as the proceeds are paid out, how they're taxed as well. So a lot of people don't really realise how that works until they're going through that situation, and that's where the frustration occurs.
Yeah, absolutely. And, this is a really tough area. It can be quite a sobering job, I'm sure, having to deal with these types of situations for individuals where they're going through hardship and they're needing that support. And so what actually attracted you to get into risk advice in the first place? There's
kind of a running joke in our industry that a lot of people, they fall into this industry, they fall into this job, they don't necessarily aspire to be a risk advisor.
Hey, Mum, I'm going to be an insurance advisor when I'm older.
Yeah. So for me, it was really, I wanted to do financial planning. I always knew I wanted to do that from high school. I just didn't know what I wanted to do. I was at uni at the time, and I thought, look, I'm actually going to go back to part-time work and get a job in the field and make sure it's really for me. And funnily enough, I fell into life insurance. It was a very niche area I didn't really know existed, especially where you could specialise in it. And that was essentially, that was it from the get-go. I've been in the industry nearly 10 years now, and once you go through the process of helping people, you realise the value add that you can bring to people, and it kind of attracts you to keep on doing what we do.
Yeah, that's exactly right. And so I'm assuming that there's lots of moments in your career where you kind of go, you know, it's been tough, but these are the things that keep me wanting to be here and keep me wanting to do it. Can you maybe share something in your time advising?
There's always one specific claim that sticks out in my mind. I was quite young at the time, and I had a client who was the sole provider for his family. His wife was stay-at-home. He had 2 young kids, ran his own family business. He worked 6 days a week. So Saturdays, you know, just because of how busy he was, bringing in money, etc. And he had a situation occur where he had to go and claim, and his income, he had kind of 2 subcontractors for him, but they didn't run the business off. He wasn't there, work didn't show up, you know, income stopped, and that's what happened. So his income fell off a cliff as soon as he stopped working, which means the family income essentially fell off a cliff because the wife was stay at home with the 2 young boys. So there was a situation where I went to do the claims kind of wrap up, you know, at their house, and his wife was standing there in the kitchen and said, "Corey, I can't thank you enough. You've saved our life." And that was a really heavy moment.
Gives me goosebumps, actually.
I get very emotional thinking about it. But, you know, it was one of those things where I drove home from the Gold Coast to Brisbane with the radio off for 45 minutes, just kind of letting that sink in. Yeah. So that was very emotional, but very rewarding. And it's a funny thing to say when it's rewarding, because, you know, someone's going through a really poor experience, but it's rewarding because you're able to make things financially okay, so they can deal with the emotional side of what's going on in their life.
That's right, and there's just one less thing that they have to be worrying about, because, you know, at times like that you need to be able to put your full attention to supporting the person that's going through that, supporting the kids if you've got kids and the family around you.
Yeah, and like the kids just didn't know any different. You know, like they were 5 and 8 or something, like around that age young. At that time. This was a few years ago, so, you know, for them they had no idea what was going on around them. You know, if they didn't have any cover, he didn't have any cover in his super fund, so he had personal income protection that he held, and without that they would have had no other choice really. He would have had to try and continue to work. His health would have really deteriorated. He could have ended up in a really poor position, but he was able to rely on his cover, go through his claim process, and now he's back at work. So
that's a great outcome.
It's a really good outcome. Yeah.
And when you talk about that, you know, talking about super, for many Australians, the only insurance that they actually have is in their super. You know, what makes that worse? Statistically, there's stats that were released by the Financial Services Council, the FSC, in 2023 that actually showed that as many as 1 million Australians are underinsured for things like life insurance and total permanent disablement, and 3 times as many for income protection. So, you know, in that typical situation, when you're seeing new clients come to you, do you see most of those cases where they actually have a need for insurance cover, knowing those underinsurance figures? Yeah,
most of the time, definitely. And this can be answered in 2 different parts. So if a new client is coming to us and they've never received advice in this space before, then traditionally what we see is they have a super fund with some default levels of cover, and the default levels are quite they're quite small for what they need. It might be 200-300 grand of life and TPD.
Yeah, and I mean, if we put that in perspective, I just heard on the radio this morning that the median property price at the moment is 1.1 million.
Yeah, exactly.
And if you've got a mortgage on that, it's probably going to be more than a couple $1,000, a couple $100,000.
Yeah, for sure. And I mean, everyone's situation is different, but majority of the time you'll see people with, if you have a younger couple, maybe 35 with 2 kids, they've probably got debt of $500,000 to $1 million, and if they have a $300,000, say, TPD policy, that gets paid out, and if it's paid out as super, there's potentially tax that's paid on it as well. So that 300 grand could be taxed up to 22%, depending on the formula around how long they've been in the fund, the years to retirement, etc. But if say they end up with a net amount of 250,000 at 35 years old, not able to work with a mortgage, it makes things very tough.
Yeah.
So majority of the time, yes, we see a lot of underinsurance. if a client is coming to us where they've previously received advice in this space, then there's two different areas that we see is they've generally got an underinsurance because their life has evolved and they haven't reviewed their cover over time. So i.e. maybe additional kids have come, kids are now in high school, they might be in private school, they've taken on more debt, upgraded the home. So if they haven't looked at their cover in the last number of years, then their situation is different to what their cover is offering them. And then on the flip side, if their situation has grown and their wealth position has increased quite well, then they might have overinsurance. And that's always, ideally, I find what people are looking for because, this is a grudge purchase. We're pretty realistic on that, but it's a really necessary purchase for the unfortunate event. So it's always a good situation where we're able to go to clients, you've got all this cover, you actually don't need all this. We've run the numbers, you can reduce to this amount, it's going to save some premium, you can direct more to savings, direct more to investments. So that's a good outcome too. And that's a really good value add because although clients will never be unhappy with too much money showing up in the event of a claim, I've never had a client complain about that. It's always a good win when you're able to save on some premium, restructure things, put some more context to where their life is now based on what their cover is as well.
I think that's a really great point. I think it's good to know that it's not a set and forget strategy.
No.
You purchase some insurance at the start, and then as your life changes, you might need to level up cover, or you might have grown assets and you need to reduce down cover to save on your cash flow and whatnot. I think that's a great advantage of working with a risk insurance specialist.
For sure, and that's what we see over time is it just can't be a set and forget strategy because things happen, increases and decreases in income. Same with debt, children, marriage breakdowns or separations. It changes your life completely in that situation. So your cover needs to be reviewed accordingly, which also comes back to making sure that your beneficiaries are looked at. So there's a lot more that will go into that situation that needs to be looked at. Yeah,
great. And I think we're talking a little bit on our next podcast specifically about those areas of beneficiaries in super and whatnot too. So that's a great lead in for our listeners to listen into the next podcast we do with Corey. I did want to just touch for our listeners again, if you didn't pick that up, the really interesting point that Corey was talking about with superannuation. When those insurances are paid out of superannuation, they can be bearing tax. And like Corey said, that can be, what was the percentage that you said up to?
Up to 22%.
Up to 22%. So, if you're taking a look at your super statements, just note that out, have a bit of a look and go, well, if the figure that I've got on here, if I only got 78% of that in my hand, am I going to be happy with that? Obviously, there might be a little bit less payable, and we won't go into those technicalities, but that's just a really good one for listeners to be considering there. And so you were speaking then about the opportunity to be reducing cover when you do get to a position as your life changes and getting those cost savings in. But say you didn't see somebody and they remained underinsured. What do you think are some of the biggest implications of not going and making that step?
So if you work through the different products, depending on the claimable event that may occur from an underinsurance perspective, if the most severe one being life cover, someone's passed away, depending on what your situation looks like, if your spouse is employed at the time and working, or whether you're the sole income generator, can have huge impacts on what you leave behind for your family. If you're the main income generator and that ceases with you, then if you're underinsured, it puts a lot of financial burden on the surviving spouse to go and earn an income to service debt that may not be cleared off, put kids through school, education costs, general living costs. So that's where, it leaves a very heavy financial burden in that aspect. Same with a TPD scenario, which is total and permanent disability. That's generally a stickier scenario to deal with because you're actually still around.
Yeah.
You haven't exited
the
situation.
You've still got all those costs in place for yourself, your needs.
You might be underinsured, like referring back to your cover inside your super fund, your default cover. It might be $300,000, which will already leave you not enough money to even clear your debt. But the other thing to think about is, your ongoing costs of care, whether you need rehab services if you're learning to walk again. If that's not being provided for by your spouse in terms of the caring, then that needs to be outsourced. Same thing with what a lot of people don't think about is home modifications, car modifications. You know, if you have an accident, you're in a wheelchair and you've got a 2-story home, that's going to be really difficult for you on a daily basis. So your options are either modify the home or find a new home.
Yeah.
And modifying a home, if anyone's done renovations, can be quite expensive.
Exorbitant, yeah.
Yeah, so we generally like to build in those additional costs into our methodology to deal with that. Because if we run through an analysis and say, look, this person needs $1.3 million of TPD cover, then we'll have a discussion about saying, well, you probably should consider an additional top-up of that sum insured to deal with those unexpected costs. And that can be, it's very unexpected depending on what occurs, you know, and it might be home modifications or car modifications, rehab services like I mentioned. So the insurers provide us a lot of good data around, you know, expected cost of care for those things, so it helps us build a methodology around it. And same with your income protection as well. Your income protection, if you're underinsured, for those of you that don't know, it protects 75% of your income. On the newer products, it's 70%. There's a bit of technicality around it, which I won't go into a lot of detail about, but generally speaking, 70 to 75%. Now, what people don't also understand sometimes is that amount is also it's assessable income, so you've got to pay tax on that.
So you're going to get less in the hand.
Yeah, although you're only, if you're earning, say, 100,000 and you can insure 75, that's obviously 75,000, but you've got to pay tax on that amount. The insurers treat you like a sole trader. So you've got to manage, they pay you all the income, you've got to manage your own tax. And for people that have always been PAYG employees, that's a very unknown territory to deal with.
You have to put tax aside. And
correct, yeah, which can be unknown for them. So if you're underinsured, the point of my story is if you're underinsured already, then you're going to be, and then you're paying tax on that underinsured amount, your income could halve overnight.
Yeah.
And a lot of people generally live within their means, so if they need all that income to meet their living and lifestyle expenses as well as their debt expenses, it can make things very hard for them.
Absolutely. And I think you kind of touched a bit earlier on there about if you were the sole income earner or the higher income earner in a situation and something did happen to you, it can have a major impact. It can have just as major impact if you're not earning $1 in the relationship, and maybe your the responsibilities that you take on for the family are to look after young children, or to get them to school, or to provide care, or to, you know, be that support person. So I think something that I hear a lot is, but, you know, we just need to insure my partner because they're the one that's earning the income. That's just not the case, is it?
No, I get that frequently. A lot of people, you know, it's frequently the stay-at-home spouse will be really concerned about the income generator and losing that. But then I sit there and go, well, that person's able to go out and earn that significant income because you're at home taking the kids to and from school and running the household. And if you aren't doing that, who is?
Yeah.
That person going out to earn that income either has to reduce their work hours, which reduces the income, or they need to find other arrangements. So it still has a really big financial impact for the family, even if the stay-at-home spouse has an illness or injury. So, you know, a lot of people by nature want to protect the person who's earning all the income or most of the income, but it's just about educating and providing some context around saying, well, let's just have a chat about what actually will occur in your life if something happens to you at home.
Yeah.
And once you do that, you can see people start to, because it's probably not something they really get out of bed and think about. So it's a lot of what we do is educating them on you know, policies, how they work, what needs to be covered for, considerations, and that's pretty much half to most of our job.
It's a big job.
Yeah.
So for our listeners, if you're just tuning in, we're talking to Corey Evans from Personal Risk Professionals today about insurance cover, and we've talked a little bit about the reason that you should have insurance and should make sure that you're not underinsured. You've spoken a little bit about income protection too, and one thing that kind of struck me is that there is a difference between, you know, so if I didn't have an income protection policy and I said, well, if something happened to me at work though, it's okay because I've got work cover. But there's a difference between work cover and income protection, right? For
sure. The main difference between it is work cover protects you for, say, injuries that occur at work. If something happens to you outside of work, you have an illness outside of work cover doesn't respond. You know, traditionally workers' comp, whatever you want to call it. But Yes, that even driving to and from your workplace, WorkCover doesn't protect you.
Oh, wow.
So depending on, there are technicalities around it, like if your job requires you to work to travel, then. But traditionally, if you're driving from home to your employer's office, that doesn't protect you if you have an accident. So your workers' comp kicks in if you're unlucky enough to have an injury at the workplace. But if you have an injury or illness in your general life, it doesn't respond. Where income protection is 24/7 worldwide, it responds regardless, and it responds to any injury or illness that prevents you from going to earn your income, essentially.
Yeah, okay. So if you've gone to Bali and you've tripped over a rock and broken your leg,
correct,
you're actually covered under income protection.
Yes, correct.
Oh, that's probably something that a lot of people don't know.
No, yeah, and that's like I mentioned earlier. A lot of that is about educating people on how these policies actually work, which feeds back to a lot of frustration with people not understanding how it responds and having a bit of, I guess, beef with the insurers at the end of the day. Yeah,
absolutely. And so say I then am in a position where I go, I need some insurance cover. I need to come and see a Corey and work this out, or I want to start the process myself. I need income protection, or I need total permanent disablement. Where do you even start to understand how much insurance is needed?
So what we generally do is, like I mentioned, a lot is just going to feed back to each other, but it's getting people to talk about their situation. So we kind of get clients to answer these questions without even having them know they're answering the questions. So I'll sit down and ask, what's your? We generally start with your asset and liability position, and if something happens to you, we work through those events of saying, look, someone passes away, what needs to be protected in terms of debt. If you have a spouse that continues to work, there's going to be income coming in. If the spouse is not working and doesn't want to return to work, we need to cater for ongoing living expenses. So it's just working through, if someone completely exits, what does your situation look like? What are the non-negotiables that debt needs to be covered off? What are your living expenses? What do you want to live off per year, and what can you live off first? What do you want to live off? So it's just getting clients to freely talk about their situation, and then essentially formulating an analysis around that. A bit of numbers goes into it around essentially a plus minus exercise. We start with a lot of your things that you want to cover off in each triggering event. We look at what number that essentially spits out, and then we'll look at what disposable assets you have available to you to offset that need. So we want to look at insurance as like essentially the last line of defence. It covers the gap between what you can't self-insure. And there might be some people that have, I've spoken to clients that have investment properties, and some clients will say, look, I'll just sell the investment property off and I'll clear the debt. Some people say, look, I've worked hard to accumulate those properties. I don't want to have to sell them off, and, we just cover that debt.
And they might also have those considerations for differing market conditions, and would I be able to just sell a property at the drop of a hat and get access to money?
That's a really good point, because I have a lot of clients who are asset rich and not cash flow poor, but for the assets they've had, there's not a lot of cash flow coming through. So they can self-insure if they liquidate the assets. And we have a chat about, well, how quickly are you going to be able to wind up this business? How quickly can you sell this house? What if the market's no good at that time? So we might do some strategies around, okay, well, what are your debt expenses on these items that need to be protected for, say, 6 months or 12 months, so you can at least wind up the businesses, get the properties ready, and you can not worry about income coming in to support that debt.
Absolutely.
So it's just maybe 12 months worth of servicing, so you've got time. Essentially, you're paying a premium to buy some time to sort out your affairs.
And that could be huge, because we talk to clients a lot about the fact that, the smarts around investing is that you buy when it's low and sell when it's high. But if you're forced into a situation that something happens to you in the middle of a COVID event or a GFC event or a property market downturn, you're exactly right. If you're forced to sell, then you're realising what could be some real losses, which you can't recuperate back in a hurry. And when you need the money, you need the money.
Your hand is forced at that point, and you'll do it because you have to, not because you want to.
Yeah, absolutely.
Which is a big key.
Yeah, and so we've spoken a little bit about super today, and as I said, it is one place that insurance can be held in. For many of our listeners, they might not know that there are some of those drawbacks. So you spoke a little bit to the taxation, but there are some drawbacks to holding your insurance cover inside super. Do you want to talk a little bit more to some of those?
Yep, I could probably speak for 30 minutes on this, so I'll cover off a lot of the main points. A lot of the issues around insurance held within super can be, there's pros and cons to it, and it needs to be looked at on everyone's individual basis. The issues around default cover, like we mentioned earlier, is if it hasn't been reviewed, it's generally quite low for what they need.
And so default cover, just to sort of hone on that one then, it's also not going to have a contract based on your health situation too. Am I understanding that right?
So it's essentially cover that's given to you when you join the fund. So it's free cover that's not medically underwritten.
Yeah.
And it's not medically underwritten on the basis that they're providing the same levels of cover or unitised, so blocks of cover based on your age. You might get 4 unit blocks worth $100,000 each, and as you get older, the value of those units decrease. That's what a lot of people get caught up as well in. As you get older, those units will decrease, which generally, as you get older into your 30s and 40s, you kind of like a bell curve. Your need for cover at that time is going to be at the highest point. You've most likely got the highest debt you'll ever have. You've got kids that are growing up, and if anyone that's got kids, they're really expensive. So, that's a situation where your need for cover is going to be at an all-time high, and then it's going to start reducing off. And if something happens to you in that time where your cover's reducing off, but your need's still really high, it can be really confronting for a lot of people. Now, that's on the default cover. Also, there's situations around the quality of cover in terms of the contract terms and conditions. So, for example, TPD cover. There's 2 main different working definitions you can be insured for. The one inside super is any occupation, which looks at your previous education, training and experience and says, well, you can't do what you were doing at the time of disablement, but you're trained, qualified or experienced to go do another job. So therefore the claim gets denied because you can go back and do something else. And so the point on that is the more qualifications you have, the more experience you have, the more specialised your employment is, it creates a really high risk that you might not get a claim paid.
Yeah. I actually heard an interesting case around that once where there was a lady who worked in healthcare and so had her nursing qualifications and was in a role where she's earning decent wages because of that. And had an any occupation definition, and they had an expectation on her that she could go back and be a phone operator in health services, get paid a considerably lower wage, but you've got the expertise to be able to do that, right? So
Correct.
That's kind of a risk of any occupation.
Yeah, if you've got transferable skills, it creates a big risk.
Yeah.
Because you can go from earning, if you've worked up the food chain, so to speak, in your industry, you could go from earning good money to earning something that you were earning 10 years ago because you've had to essentially drop back to another role. And the easiest one to example that I use with people is, if you have a really specialised doctor, say like a surgeon, and the surgeon is doing some renovations at home on the weekend and using the drop saw and cuts off an index finger, that person's not going to be able to hold utensils to perform surgery. But a surgeon is going to have education, training, experience to go back and do another role in the medical field, whether that be GP or consulting or the like. So under any occupation wouldn't get a claim paid. Whereas the alternative is own occupation, which essentially is whatever you were doing at the time of disablement, can you perform that role again, yes or no? So it's a much more narrow scoped assessment and, in my opinion, a more favourable assessment, because what we're trying to do is provide as much certainty and clarity that a claim's going to be paid at the claim time.
Wow. And so inside super, it's most typically that any occupation. And so
it will be, because not to get into the kind of nuances of superannuation and the technicalities, but own occupation doesn't meet a condition of release from your super fund.
Oh, okay.
So the other thing that might be good to highlight for the people listening is this came in 2014, that legislation change. There may be people, I've seen people with own occupation TPD cover inside their SMSF, for example.
Okay.
And so the risk there is the claim would still get paid. The money just gets trapped in the super fund because it can't be released.
Wow. So if you've got a self-managed super fund, that's a real point of checking and seeing if you did have the risk of the money not being where you need it to be.
Yeah.
and then it's stuck there until 60 or
Yeah.
condition of release.
Correct, yeah, until maybe your health deteriorates to when you do reach any occupation stage. But if
Yeah.
it doesn't, then you've got to meet another condition of release, which is typically, your preservation age at 60. So that can cause issues.
My goodness, that would be not worth the premiums that you've paid
No.
for it at that time, huh?
No, not at all. So that's really important about educating people, on that and how it works.
Yeah.
Once you explain that. And the other issue really is TPD with any occupation is quite onerous to go through a claims process because, we've had a situation where a client had a car accident and had cognitive impairment. From any occupation TPD perspective, the doctor wouldn't sign off that this person couldn't return to work because we had to reach what they call medical maximum improvement. So the client had to, because she was showing signs of improving her cognitive ability, it wasn't until she plateaued where the doctor said, okay, we're comfortable in signing this off.
Yeah,
So that was a nearly 9-month process.
Wow. And when you do have to have anybody in the medical profession involved with these things, as we know, that can take time, even if it is the simplest, easiest process. We know that it takes time to get to specialists and it takes time for them to do the paperwork and dot the I's and cross the T's.
Yeah, and although they are the medical specialists, sometimes what we need to do is educate the doctors on what they're actually assessing the client on. So educating the doctor that this is the assessment that needs to be done based on the definition of this policy within the PDS.
Yes.
So assess it accordingly. Don't make up your own mind on things. You just need to assess the definition that's being presented for the client's policy.
Yeah, absolutely. And so you can work with the specialists in terms of trying to help get the best outcomes possible.
Yeah, essentially. Yeah.
Okay, wow. Well, there's definitely a lot to think about inside the super environment. And like you say, I think we could probably talk about that for a lot of time, and we might hit on some of those others in another podcast. But so if we've got to the position now that we've decided we need some cover because we're underinsured, I know how much cover I need to go out and get because I've thought about all those points that you've spoken about in terms of how much me and my family might need. How do you then assess who is the best insurer? Are there any tools that you can direct our listeners to that they might want to do as a starting point or that can help in that area? Or how do you do that?
That's a kind of difficult one because from a retail policy perspective, the policies need to be accessed through an advisor. They typically can't. The insurers do have their own direct products which you can compare. Generally, though, what we want to look at is for 90% of the time, it's a health perspective. Most clients generally have some sort of health history, so we need to do what we call pre-assessments around that person's health to determine what insurer is going to be best based on the medical profile.
Yes.
So it's similar to banks like mortgage broking. We want to go through the industry, have a look at the insurers, because some insurers have sweet spots. They might be better for musculoskeletal conditions. They might be better for heart and cardiovascular conditions. So if you do present with a medical history, the insurers have different guidelines around what they'll exclude and what they might add a loading for. Loading is essentially a medical premium loading. So you present a higher risk to the insurer, so therefore you pay a higher premium to someone who doesn't present with the same history. And a good example of that might be someone presenting with family history of breast cancer and under a certain age, immediate family. Some of the insurers will exclude that condition from your trauma and income protection or TPD, and some insurers will actually offer a premium loading. So although the premium is going to be more expensive for the cover, we would like to have the client covered for the condition than not. So kind of triaging the market to find the best outcome is really where we want to start from a health perspective.
And I think what's important there is that if you didn't have that information, so for example, I have insurance cover and I know that I've got scoliosis, so I've got a spinal exclusion on policies. But I also know that this was the best outcome that I could get from that situation, right? If I didn't know that there was a better option for me though, and I just went and bought an off-the-shelf product, and they did assess me and say, well, here's a exclusion on your policy or a loading on your policy, and you went, well, I don't like that. That's not very fair. I'll just go to another insurer now. that other insurer's first question is going to be, have you had insurance with loadings and exclusions before? And they're probably going to take similar outcome versus they go and speak to an insurance specialist like yourself and you go, hang on a second, you've just told me that you've been smoking, but you intend on quitting, and I can tell you that you need to wait for X amount period of time, and then we would be able to get your premium cheaper, I assume.
Yeah.
Right?
Yeah, correct. Yeah, smoking's a big one. Generally, the premiums are about 40% more expensive. So it can
better give them up.
It can add up. Yeah. And the good thing is you only have to be a non-smoker for 12 months, and then you do a declaration to say you haven't smoked for the last 12 months, so therefore your premiums reduce, and that's a big one for a lot of people is the premiums on smoker rates.
Yeah, definitely. What a better incentive to give them up, throw them out.
Yeah, that's it.
And it's not like car insurance though, right? You can't be when it comes to the insurance that you've got in place, should you really be going and saying, I'm going to shop this around every year and try and get a cheaper cost elsewhere? What should people be doing in that space?
Well, generally there's a few gates we want to open when looking at another insurer, and the main one, the biggest one, is your health, because we may have secured a policy for you when you were 35, and you may have had a little bit of medical history, but nothing that warranted a loading or exclusion. If you fast forward, say, 5 years, and you've had a family member have an illness, you've had an illness of your own, it could be as simple as a lot of the one is, polyps being removed. They might be benign, but they might have kind of cancerous aspects to them. So there might be exclusions for colon cancer and stuff like that. So a lot of people don't generally think they've had a health issue, but from an underwriting perspective, it's a concern, because the underwriters with these insurers, they're guaranteed renewable contracts. So that means they're legally binding. The underwriters get one roll of the dice to medically assess you. They're assessing your life from when you were born up until application time, and they're assessing your health, what may occur until the policy expires. So if you're 30 years old and the policy expires at 65, they're underwriting the next 35 years of what's in your medical history. So that's why it's important for a lot of people to understand that, what they consider health changes may be different to what underwriters consider.
Yeah,
because they've got to look at the long-term risks that are presenting as well. So you don't want to just be chopping and changing around on that aspect. You want to make sure that you're actually going to get the same underwriting terms. So we want to make sure if we're moving you to another insurer, the medical outcome is the same. We're not putting you in a worse position. We want to make sure that the quality of cover is still on par or ideally better. That you could easily save money, with your car, for example, going from a Maserati to a Mazda. You can achieve the same result in your insurance cover. You get what you pay for.
Yeah.
So, and then the last one is ideally we want to cover off the medical side, the quality of cover, and the cost as well. So you're not going to move cover essentially unless you're looking for improved quality, which results in an increased premium. Yeah. So that's why that's generally why a lot of people are coming back to us and saying, look, we want to try and find a cheaper premium. But it's then going, okay, well, we need to understand what's changed in your health. The quality of cover might not be the same. And that's important because there's been a lot of changes on the income protection market, specifically post-Royal Commission. So there's a lot of policies out there that are now called legacy policies or grandfathered policies, which have terms and conditions which no longer exist in the marketplace. Yeah. So yes, if you went and reviewed your income protection cover, there might be cheaper options out there, but what you're not understanding is the benefits that you're foregoing as a result of moving to the new product, because you're losing terms and conditions that don't exist. So if you're downgrading your cover, it's going to be cheaper. Yeah,
okay. Wow, there's a lot to think about in there. And I think for our listeners, if they haven't already picked it up, insurance is a complicated area, and seeing a specialist can make all of this so much easier. So, in your opinion, why is working with a life risk insurance specialist, my goodness, there's a lot of words in that, a great option?
Well, I guess overall from what we've discussed, it's allowing us to do the heavy lifting for you right from the get-go all the way through the policy life. So we're able to help you formulate cover that's right for your needs, structured correctly, paid correctly, reviewed over time. It's not a set and forget strategy. So as your situation changes, we need to develop and improve your portfolio, either increasing or decreasing as needed. But then most importantly, you have an advocate at claim time. You have someone in your corner to deal with the insurer. We're able to help you deal with what you need to medically, and we'll make sure that funds show up to do the jobs that they need to do.
Absolutely.
So,
and I imagine that claims process, when an insurer sees an advisor attached to a policy, I'm sure that they make that process easier.
Yeah, for sure. And I mean, at the end of the day, we are their distribution network as advisors. That they need to, and they want to keep us happy.
Yeah.
So
Yeah,
if we're involved, things are going to go smoothly. As a risk specialist as well, we have certain contacts at the insurer that we can push through when we need to. So we can get things done, as opposed to someone calling and dealing with the general claims team or admin team, for example. We can kind of target who we need to get results.
Absolutely. Well, I think we might wrap up there. We hope that today's been good in providing you with some food for thought for our listeners about your own risk insurance needs. Perhaps it's time to get out your super statement and take a good look at what you are or are not covered for. Maybe you and your partner are thinking about protecting yourselves and your loved ones, and now's a great time to think about how much is the right amount for you. If you're seeking tailored risk insurance planning advice, please feel free to make contact with Corey directly at Personal Risk Professionals. He and the team will be happy to help you. Thank you so much, Corey, for being on today's
Pleasure.
podcast. We really appreciate
thanks
that.
for having me.
Now, if you like today's episode, please don't forget to follow us and share us with your friends and family or anyone that you think could benefit from listening. We also value your feedback, so get in touch. Tell us what you liked or didn't like or want to hear more of. Tune in next time for another Wealth Experience podcast. The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.